Why smart money left before the headlines? It didn't happen during a crash. It didn't happen after a warning. It happened quietly, weeks before anyone thought there was a reason to worry. Capital began leaving, not in panic, not in haste, but with deliberate calm. To understand why this matters, we need to revisit a moment when markets appeared stable and confidence felt earned. Prices were strong. Volatility was manageable. News cycles were supportive. To most investors, there was no signal to exit. But smart money doesn't wait for signals. It watches conditions. This story matters now because the biggest moves in markets are rarely made in public. They're made in silence, long before explanations exist. By the time headlines appear, positioning has already changed, and the opportunity is gone. The first reveal begins with how smart money evaluates risk differently. It doesn't look for direction. It looks for asymmetry. When upside becomes crowded and downside grows expensive, the trade is no longer about returns. It's about exposure. And in this period, exposure quietly became harder to justify. The second reveal appeared in allocation behavior. Large funds began reducing sensitivity to market moves, not selling outright, but shifting into structures that required less commitment. Duration shortened. Liquidity preference increased. Optionality replaced conviction. To the casual observer, portfolios looked unchanged, but the intent behind them had shifted. The third reveal came through absence. Smart money stopped defending levels it once supported. Pullbacks that would normally attract aggressive buying now met passive interest instead. Prices still held, but only because there was no pressure. Yet, support remained visible but fragile. Those watching closely understood what was happening. This wasn't fear. It was preparation. Capital was stepping aside without leaving footprints, waiting for confirmation rather than assuming continuity. And once smart money leaves quietly, the market becomes something else entirely. It becomes louder, more reactive, more fragile. The headlines just hadn't caught up yet. As smart money stepped back, the market surface gave no obvious signal. Retail participation stayed strong. Momentum traders remained active. Algorithms continued executing with precision. To most participants, activity looked healthy. But healthy markets require depth, not just movement. And depth was quietly fading. The conflict began when small stresses failed to resolve cleanly. Minor sell-offs took longer to stabilize. Bounces looked forced. Volume increased without conviction. These weren't breakdowns, they were hesitations. And hesitation, when repeated, reveals absence. Institutional desks noticed a change immediately. They adjusted execution tactics, avoiding size. Market makers widened spreads incrementally, pricing in the risk of imbalance. Funding desks shortened terms. None of this appeared in daily market commentary, but together, it altered how risk traveled through the system. The tension deepened when derivatives markets reflected the shift. Implied protection became more expensive. Skew changed shape. Traders hedged differently, not expecting a crash, but expecting surprise. Smart money wasn't betting against the market. It was betting against certainty. The buildup continued as correlation structures tightened. Assets that usually absorb stress independently began responding together, not dramatically, but consistently. When everything moves at once, exits narrow quickly, and investors most aware of that reality were already positioned to avoid it. Still, the headlines stayed calm. Economic data was mixed but manageable. Central banks sounded confident. Volatility remained low enough to reassure casual observers. But smart money had stopped listening to reassurance. It was listening to behavior. The market grew increasingly dependent on participants willing to take risk without protection. And that kind of participation is fragile by nature. It disappears the moment conditions change. The final signal came not as a sell-off, but as silence. Key levels broke and recovered weakly. Opportunities appeared, but no one with scale rushed in to claim them. It wasn't that buyers didn't exist. It was that the right buyers had already chosen patience. By the time the market faced its next real test, smart money wasn't watching nervously. It was already elsewhere, waiting. The test arrived the way it usually does, without ceremony. A modest shock, A data point that disappointed slightly. A policy comment that introduced ambiguity instead of clarity. Nothing that justified alarm. But in a market already hollowed by quiet exits, even small uncertainty carries weight. Prices slipped, then paused. In previous cycles, this was the moment smart money would step in, absorbing pressure and restoring balance. This time, that bid was missing. What followed wasn't panic, it was imbalance. Selling mid-air. Orders chased liquidity instead of finding it. The conflict escalated as leverage strategies reacted automatically. Risk systems adjusted exposure. Stop levels triggered. What had been a controlled pullback became a cascade of forced decisions, not because investors were afraid, but because the structure no longer allowed patience. Smart money watched from the sidelines. They had seen this sequence before. The silence, the hesitation, the sudden acceleration. When markets rely on participation from the least protected players, stability becomes conditional, and conditions had just changed. Volatility expanded rapidly. Correlations snapped into place. Assets that once offset each other began falling together. The market's reaction wasn't emotional, it was mechanical. And mechanical moves, once started, don't negotiate. The buildup reached its peak as news outlets rushed to explain the movement. Narratives formed in real time. Analysts debated causes. Traders searched for a bottom. But smart money wasn't searching. It was observing, waiting for prices to move far enough that asymmetry returned. The realization spread quickly across desks. The market wasn't overreacting. It was recalibrating to the absence of its stabilizers. The people who normally soften shocks had already left. Not because they knew what would happen, but because they knew how markets behave when confidence thins. By the time buyers reappeared with conviction, damage had already been done. Levels once considered support had failed. Portfolios built on smooth execution had suffered irreversible losses. The opportunity to exit quietly had passed. Smart money returned only when silence returned. Not the calm before the storm, but the calm after acceptance. Because smart money doesn't chase headlines. It moves before them. And by the time the story makes sense, the positioning that mattered is already history. The aftermath unfolded exactly as smart money expected. Once the forced selling ran its course, markets slowed. Volatility stopped climbing. Prices found temporary balance, not because confidence returned, but because pressure had exhausted itself. The absence that once destabilized the system now created space for rebuilding. The climax wasn't the sell-off itself. It was a realization that nothing fundamental had suddenly changed. No catastrophic data. No hidden collapse. The damage came from structure, not surprise. From a market that depended on participants who had already chosen not to be there. Executives reviewed timelines and asked the wrong questions at first. What news caused this? Which headline triggered the move? But the deeper review told a different story. Capital had been repositioned long before the first red candles appeared. Liquidity had thinned by choice, not fear. Stability had relied on assumption, not commitment. As markets stabilized, smart money re-entered selectively. Not everywhere, not immediately. Only where asymmetry returned, where prices reflected uncertainty honestly instead of pretending it didn't exist. They weren't rushing to reclaim old levels. They were building from new ones. The resolution came quietly, without ceremony. Funds adjusted frameworks. Risk teams reevaluated participation assumptions. Some institutions acknowledged that their greatest vulnerability wasn't timing. It was dependence. Dependence on buyers who would disappear the moment conditions shifted. The lesson lingered long after volatility faded. Markets don't collapse when people panic. They weaken when the most disciplined participants step away silently. Headlines capture reactions. Smart money shapes conditions. What made this episode so instructive wasn't how fast prices fell, but how long the exit had been underway before anyone noticed. By the time explanations felt obvious, the decision that mattered had already been made. Smart money didn't leave because it knew what would happen. It left because it understood what could happen when stability becomes crowded, liquidity becomes conditional, and patience becomes rare. And that understanding never makes the news. So, what do you think? Are we watching the same quiet exits happen again? Right now,